Many people today, even those earning decent incomes, describe a constant feeling of falling behind. You work the same hours and earn the promotions already at work within the average household. This danger stems from managing money in 2026 using a financial playbook written for 2019. The rules that provided security just a few years ago are poorly suited for the current landscape. The economic environment has undergone a structural shift. We are now operating in a landscape of permanently elevated prices, interest rates that are significantly higher than we became accustomed to, and artificial intelligence actively restructuring entire industries. These shifts are not temporary fluctuations. Maintaining the same financial habits while these macro pressures mount leads to a steady erosion of security, making the development of a new strategy a requirement for survival. For years, the prevailing wisdom suggested that holding cash was a mistake. With interest rates near zero, money sitting in a standard bank account steadily lost purchasing power as inflation outpaced any meager returns. That calculation has changed. Today, savings accounts, money market funds, and short-term treasury products provide meaningful, competitive yields. While the yield is useful, the primary utility of cash lies in its role as a shock absorber. When AI-driven layoffs hit or an industry rapidly restructures, this liquid buffer absorbs the impact that would otherwise break a household's finances. Holding 3 to 6 months of essential expenses in cash serves a specific defensive purpose. It ensures that a temporary job disruption does not spiral into a permanent financial disaster. The traditional blueprint for financial security was straightforward. A worker obtained one job, remained with that single employer, and eventually retired. In a volatile economy, relying entirely on one source of income creates a concentrated point of failure. If that single paycheck stops, the entire household stability snaps along with it. Millions of households are patching this vulnerability by supplementing their primary income through consulting, digital products, or small-scale freelancing. Even an extra $500 a month significantly reduces the risk of a total financial collapse. Protecting your income also requires a proactive defense against automation. Acquiring new certifications and mastering the technologies currently disrupting your field makes you far more difficult to replace. Actively engineering multiple income streams and increasing your earning power frequently produces better results than the most aggressive attempts to cut household expenses. During the era of cheap borrowing, consumers could carry casual credit card balances without facing immediate, severe financial consequences. The new mathematical reality is harsher. With credit card rates frequently exceeding 20%, balances create an exponential trap, outpacing your ability to earn. Elevated costs for housing and utilities compound this issue, leaving less capital to pay down debt, visually squeezing disposable income. In this environment, budgeting has evolved into a strategic necessity. Every dollar now faces intense competition from rising baseline costs and aggressive interest rates. Aggressively eliminating high-interest consumer debt provides a guaranteed risk-free return. In many cases, the money saved on interest outpaces the returns available in any traditional market investment. A decade of rising markets conditioned many investors to aggressively chase the latest trends, betting heavily on whatever asset was climbing the fastest at the moment. Attempting to predict a next market move is an exercise in futility. We are navigating expanding government debt, geopolitical tension, and rapid technological disruption. The optimal strategy is now a diversified defense. Spreading your capital across index funds, bonds, cash reserves, and international assets helps neutralize the unpredictability of any single sector. Modern investors are prioritizing survival over overnight wealth. The goal is to remain in the market long enough to safely capture long-term macro growth. Financial success in 2026 does not rely on perfectly timing a recession or hiring the most expensive advisors to forecast the future. Success is found in the basics: living below your means, maintaining an aggressive safety net, and remaining adaptable to sudden technological shifts. The households that thrive in uncertain times are rarely the most aggressive risk takers. They are usually the most resilient and conservative planners. The economic challenges of this decade act as a filter. They separate those who cling to outdated financial playbooks from those willing to accept and prepare for these new realities. Global shocks are now a recurring feature of the economy. In this environment, an engineered capacity for resilience remains the most reliable foundation for long-term security.